risk success. Bet I'm out of debt.
Money brings women.
One of the funniest things I heard was that for women, it's this thing that you can apply to. You know, you got all these blogging sites and stuff, and it's called Baller Alert.
Our slogan is, for women who want to live the ballerific life. When Michael Jordan was playing for the Wizards, at the time I was the VIP coordinator for one of the hottest clubs, a block away from the MCI Center where Michael Jordan played. We had a radio broadcast at the time, and it was a live broadcast going on. We shouted out that Michael Jordan was in the club, and maybe an hour later, 2,000 girls showed up.
This is how serious this thing is. When a baller shows up to a place, you receive a text on your phone so you can get nice and cute and go out and try and catch you a baller.
I had 7,000 girls signed up.
Wow.
Women, they take notice. They see the guys that are spending money. They see how they dress.
And so we go get the money to entertain and appease the women.
If it wasn't about women, you think a lot of guys would purchase a big rope chain or a fancy car? Probably not.
You know, you got women abound telling you how cute you are when, I was an ugly duckling maybe just a month ago.
The players complain about the gold diggers, but they do everything possible to attract them.
Ballers are groupies, too. They'll have their entourage go and find women and bring them to the VIP. It's almost like if you're watching Animal Planet.
Some athletes say they are targeted by women who are trying to get pregnant.
There are women out there that are looking to either become pregnant or marry an athlete just because of their financial status.
Hey, good morning, Patrick. It's good to be live on YouTube on a beautiful Sunday morning. How are you?
All right, good morning, Troy. I'm doing very well here in sunny Southern California.
Yeah, man. So we were just looking at that opening video. I'm about to go into another video. It's really not about how much money you make. It comes down to how much money the money you make makes. What do you want to say about that before we go into the next video?
Exactly, because you could be making $1 million a year and still be living paycheck to paycheck and have nothing to show for it at the end of your career.
Yeah, and it does come down to the ladies for the fellas, huh? We love our ladies. We will do everything we can to impress them. We'll buy nice cars. We'll have nice homes. We'll do all kinds of nice jewelry and everything. But to learn investing is relatively simple, Patrick.
Yes, it is. You could go to any top brokerage home like TD Ameritrade, Charles Schwab, and they'll teach you the basics of investing.
Well, let me show you this, Patrick. So these guys, they put all of this energy into, athletics and some guys put a lot of energy into going to work and making money to spend money on fancy cars and all of that stuff to impress women. But what you can do is learn some basic, simple techniques. Now, look at this video, Patrick. Check this out. Rather than these guys go over some of the things that we're about to go over, they choose to do something like this.
Fulford's multi-million-dollar scam with the biggest sports stars in the world. According to Sports Illustrated, Peggy Fulford's client list was a who's who of professional athletes, including Dennis Rodman, Travis Best, and Ricky Williams. Fulford promised her clients they could sit back and relax as she took care of their finances.
I do control a very large part of their life. And when you control someone's finances, that is their life.
Fulford's scheme began when she made herself an intrinsic part of Best's world. According to Sports Illustrated, they met in the early 90s, and by 2000, she was running many aspects of his life, including his money. Her next big client was Williams. According to the CNBC series American Greed, she met him by fluke when she showed up at his house with a decorator he had hired to spruce his space up for the MTV reality series Cribs. She pitched him her financial services and he accepted. As Sports Illustrated learned, Fulford's signature move was offering to work without pay and promising to help build, quote, generational wealth. It was too good for Williams to pass up. He was initially so pleased that he introduced Fulford to Lex Hilliard, who had recently lost much of the money he had invested in a pawn shop. Fulford offered him $10,000 without interest and locked in her next victim. Without a doubt, Peggy Fulford's most famed client was Dennis Rodman, and their relationship extended beyond the professional. The pair met through a mutual friend when Rodman was struggling with alcoholism, and Fulford built a connection with the NBA player. Rodman's attorney, Bradford Cohen, suggested on American Greed that Rodman was seeking emotional support from Fulford while she was after his wallet. A unique bond soon formed. As Sports Illustrated learned, Rodman would go in and out of Fulford's house freely, and he even took her oldest child, a son named Elkin King, with him to North Korea in 2013. Unfortunately, his appreciation for Fulford didn't spare him from her schemes. While stealing from her supposed friend, Fulford allowed the electricity to be cut off at his Florida condo, stopped making payments on his life insurance policy, and even took away his debit card, claiming he, quote, couldn't be trusted to spend his money responsibly. Their bond was so strong, though, that even as red flags began to mount, Rodman put his trust in Fulford. According to Oxygen, he was finally forced to accept the truth when the FBI became involved and spoke with him directly.
Look, man, if you're going to put that much energy into your career and you know you're going to make a lot of money, why not just simply learn some of the simple tools and basic techniques of investing, Patrick? I just don't get it.
Well, you got to remember that a lot of some of these ball players and maybe other high income earners, they were never taught the ABCs of financial investing. They always used to it was like a foreign language to them. It's like going back to school. It's nerdy, it's not me. I'll just put it into, I'll just, use whatever person my best friend is using, and then I'll have that as my trusted advisor. But the problem is that a lot of these trusted advisors do not always have your best interests.
And oftentimes, they don't have your best interest. There's a lot of shady characters out there. And for me, if I'm going to manage my money or lose my money, it's going to be me, not someone else, because it's hard earned. You would think with a person making that type of money and knowing that they're going to make that type of money, they would just invest a little bit of time into some of the techniques we're going to show today. So, Patrick, without further ado, let's get into a few of the basics of investing, and let's talk the stock market, because that's what we do. We do stocks and options. There's crypto guys out there, right? And there's real estate guys out there, and we both own some real estate and all of that. I'm not really a crypto guy, but let's get into some of the basics. So if you are a person that does not understand the stock market, rule one: what is one of the basic things if you don't want to spend all of your time looking at CNBC and reading publications all day? What are one of the basic things, tenets of investing in the market?
First of all, you got to understand how finance and investments work. That's number one. And once you understand how money and investing work, then you try to keep it simple.
Let's keep it there. Let's keep it super simple. So, number one, buy best of breed. It's really that simple. For us who invest in the market for many, many years, we start getting more techniques to try to refine things to make more money. But doesn't it really come down to buying best of breed companies?
Yes, you want to buy the leaders in any field. So again, you want to buy the best of breed in technology. You want to buy the best of breed in banking, the best of breed in healthcare, and so on and so forth. In other words, you want to buy stocks that will essentially be in S&P 500 components.
So
those are going to be the best of breed companies.
yeah, and I was about to go there, Patrick. Sorry, I'm just kind of jumping the gun a little bit. How do you know best of breed? Let's say I am a brand new investor, and that's what this show is for, the brand new investors out there. How would I know best of breed? You say, hey, buy them, but I think it's fairly simple. How would you know best of breed without looking at charts and all of that stuff? What would be some of the clues, Patrick?
Well, what you could do is you can go online and just see what are some of the companies that are inducted into the S&P 500 that are components of the S&P 500.
Yeah, but you go and ask, well, hold on, Patrick. You go in S&P 500 and all of that. A brand new investor wouldn't know all of that stuff. They don't even know what a S&P 500 even is. Let's simplify it even further. I would say best of breed, right? Is look at the products that everyone's buying. Look at, the Apple. Everyone has an iPhone versus, some Microsoft phone or some Pizza phone, And so everyone uses Google. So Google search. So you would look for those products or companies that provide products that are best of breed, that's just everyone uses and killing the competition. Another example, Amazon. If you want something cheap, what do, Patrick? You go on Amazon and you go and you search it. Even if you're going to buy something locally, you do a compare to Amazon on things you buy locally. So picking best of breed companies is really as simple as that. Where do you go to shop for your home? For us people who have homeowners, have homes and want to refurbish things, where do we go? We go to Home Depot, right? Exactly. Where do we go to shop to save money? We go to Costco, right? So all of those companies are great best of breed companies. And I want to show some charts to kind of reiterate some of those things. So I want to, show proof of that. And go ahead, Patrick, before I go into some of the charts to show some proof of that.
Yes, and also where a lot of people dine, that's McDonald's. Where do a lot of people go to vacation? They go to Disneyland.
There you go. And I tell you what, these children cannot do without Disney Plus and those Disney. So, it's really that simple, picking best of breed companies. At least the clues of best of breed companies. Now, once you have a suspicion of a best of breed company, then, Patrick, it's the next step that you're talking about. It's actually going and looking at something to validate if your assumptions are true. And so let's do that. Let me share my screen here. Right now, we are here on barchart.com, Patrick. It's a fave of the show, right? We love bar chart, right? So
yes, we do.
People go to barchart.com, and we're using the free version of bar chart. They have a paid version as well. But just looking at some of the charts, and before I go there, Patrick, there's one additional thing. Let's say, for instance, a person does not want to buy a company. They don't want to choose best of breed. They can also choose an index fund. And so for those who do not know what an index fund is, and you just really want to be mindless and not mindless in a bad way, but just invest your money with a pretty guaranteed method of beating and investing and growing your profits. Can you explain what an index fund is?
Well, an index fund is a fund that mimics a favorite index, such as you might buy an ETF based on the S&P 500. So it will track it 99.9999% of the time. Or you might invest in the Dow Jones Industrial Average, like a diamond, and that will track the Dow Jones Industrial Average 99.999% of the time. And then, of course, the QQQ, which is the NASDAQ 100, which is pretty much close to 100% in tracking that index. So it's a passive investment, and you don't have to go through any shady financial advisors or people who you might not trust. You can just do it yourself. Open up a brokerage firm that charges you zero commission, and you just keep dollar cost averaging over time. And then that will build wealth very, very quickly, because these are funds like the Dow Jones Industrial Average, the S&P 500, and the QQQs, which is the NASDAQ 100, that will beat like 90 to 95% of fund managers out there. So you don't have to go through what Dennis Rodman went through, right? Or many other people who make these horrible investments and end up broke at the end of their careers.
Yeah, and in that example, I did not play it, but that lady Peggy, this financial advisor,
Peggy Fulford,
she had a power of attorney over those guys, so she could just take their money in and out. But why not manage this stuff yourself? And even if you do not want to pick best of breed companies, we're going to show you here. You can pick index funds as well, right? You could pick the NASDAQ 100, the Dow, the S&P 500. And like Patrick just said, you will beat like 99%. Well, that's a little hyperbole, but you would beat most fund managers who's trying to manage your money, or even these financial advisors. Now, Patrick, you can make a lot of money from business, but business carries significant risk, and not all of us are made to be business owners. So those guys making $100 million, do you know on average the S&P 500 returns about 10%? Do you know what 10% on $100 million is, Patrick?
That's $10 million
a year. $10 million a year you can make on just passively, just putting in an index fund. These guys could have done. But I'm not mad at these guys, and I'm not going to try to hate on them because they just didn't know any better. So let's go here,
They didn't know any better. Exactly.
Let's look here. Let's go back to our healthy charts here, and let's kind of explain to our audience what we're looking at here. Now, we're looking at a 5-year chart, and I'll see if I can blow this up a bit. So we're on barchart.com. As we said before, it's a 5-year performance of a couple of indices. We have the QQQ, which represents the NASDAQ 100. We have the XPX, which represents the S&P 500. And we have the Dow. And so the Dow is another benchmark. And so if one were to put their money into those indices, then it would make these type of returns, or would have made those type of returns over a 5-year period. 50% return on the Dow, which is in red, the S&P 500 in green over a 5-year period, 72% return, Patrick. So that's better than losing your money. And with those type of returns, with $100 million, you could do the math. And then over 126% return on the NASDAQ. So that's just basic index fund investing, not even trying to beat the market, not even picking best of breed. But let me show you, Patrick, why most of us pick stocks and try to pick best of breeds. And like you said, Patrick, you want to be diverse. You want to spread your risk. So you want Costco in the retail market. You want Apple in the tech market. You may want Eli Lilly in the healthcare markets. And it's easy to find these best of breeds. There's so many publications out there. But let me show you why someone would pick stocks over just indices. So we have the QQQ here, right? Best of breed company, Apple. I'm an Apple guy.
Yes. Yeah.
And let's add Apple to, and what we're doing is comparison. So we're doing stock compare, right? I'm doing a comparison on barchart.com. Let me blow this up. And so over a 5-year period, and we're on 5 years here, over a 5-year period, look at the performance. So same performance I showed you a moment ago, the Dow, the S&P, the NASDAQ. But look at Apple over 5 year, right? So just picking a best of breed company like Apple, that's why most of us do what we do in those regards. Now, let's look at a 10-year period. What do you think, Patrick? Look at the outperformance.
Yes. Yeah, you can see that.
So 600% growth on your money, 6 times your money over 10 years versus that performance there, 381, 197, and 151. And you can see the NASDAQ traditionally has done better than the other indices. So you could just look at history and over time. And if I go 20 years, look at that. Over a 20-year period, a long-term
no
investing.
comparison at all.
Look, this is way down here. And look, a 6,000. What is that? A 6,274% return over 20 years by just leaving your money in a company like Apple. But it's not just Apple, right? We talked about other companies. Did we talk Costco? Best of breed?
Yes.
Let's throw Costco in
Costco.
comparison to the other indices, right? So let's go 5 year. So I'm 5 year here. And I'm going to blow this up for our audience. So 5 years, you can see these numbers are the same. And then the Costco is represented in the black. And it's almost double their performance over a 5-year period. And then let me go a 10-year period. Costco is represented in black, still outperforming the rest of these guys. And then let's go 20 years. That's where the rubber meets the road. And then you can look at Costco over 20 years of 1,500% return versus 1,357 and 279. So you can see that the NASDAQ historically is the better bet. So if you still don't believe me, Patrick, let's do another one. What's another best of breed company? Like we did Costco, Home Depot, Amazon. Let's do Amazon.
Yeah, let's do Amazon.
Amazon. Yeah, it's easy.
Or Google is another one.
Google would be another. And that's a 20-year period. I'm just going to go 20 year. I will just do 10 year and 20 years. So just look at the outperformance, guys. 1,000% over 10 year. Let's do 20 year. 12,000% return if you just leave your money in these type of companies. Now look, Patrick, I'm going to look down here on the x-axis. You can see the performance 2009, 2011, and the company was just building steam. You can see the company has been going up and down. Amazon, big drops, retracement, big up, big retracement. That was a good buying opportunity for those who did not get scared. And Amazon is on its way back up. So those are just examples. I mean, I could just go on and on. HD for Home Depot. Look at Home Depot. You could just keep going on and on for different companies. So,
and one thing I wanted to drive home, because despite all of that volatility of some of these stocks, like you saw how Amazon had these big dips, but the thing is, Amazon business was always best of breed, even if the stock was volatile and is volatile over time. It will still move higher because these are best of breed companies.
So I guess I'll go ahead.
So the thing is, just stay the course and stick with the top names in business.
Yep, and I guess that's the point. Best of breed. So for those who do not want to just simply rely on just pure passive investing and do a Dow, a S&P 500, or NASDAQ, you could pick best of breed, and you're pretty much going to be right if you leave your money there for the long term. And they have tools like this, barchart.com, Yahoo Finance, just to name a slew of different websites where you could just look at the performance over time. And over that period of time, you'll get an indication if what you think of best of breed is right. And that's just that. There's other techniques. There's the 50-day moving average, the 200-day moving average when you start getting into technical analysis. And then there's, additional things that you can get into to price to earning ratio, forward PE, PEG ratios, growth rates. But I'm just saying for the beginner investor, keep it simple. Pick best of breed. Go look at a chart on barchart.com. If you don't know how to do it, hit us on gmail.com, betoutofdebt@gmail. I'll be happy to personally show you for free. No charge for that at all. Actually, we really do not charge for anything. Well, we take donations for the equipment, but we really have not been charging for anything. But Patrick, maybe there's some questions. I'm not sure. I'm not even in the chat. I can't even see the chat. Maybe there's something going on in the chat. I'm not sure. I cannot even see the chat, so that's a little weird that I can't see the chat. I was going to go and pop stuff up from the chat to see if there's any questions or any comments. Oh, yeah, I have the chat up now. Oh, man, I've been missing the chat. And so, oh, man, the casual economist. This is a good channel. So the casual economist is in the building. And another fave in the building. I don't know how to pronounce that. So I need to learn how to pronounce that name. But welcome back. And Gail at Night. I need you to be a moderator, Gail at Night. Myself and Miss Jams, we love you. We love your channel. And so I need to get Gail at Night a wrench. I definitely need to get her a wrench up in here. Miss Jams is always in the building. If you guys have any questions, let us know. And we'll answer those here live on YouTube. I'm going to go right down to the bottom.
Say, hey, Miss Jams, it's good to see you as well. Thank you so much.
Yeah, so I don't see any real questions in the building other than hopefully we provided some financial information here. Do you see a question?
Yeah, one person's asking about Walmart. That's Seek Amethyst.
Seek Amethyst. Okay. Is that how you pronounce that? Let's go look at Walmart. Let's take a quick live look at Walmart. I can do Walmart here on bar chart. I can make it fairly simple. Let's WMT. Yeah. Best of breed company. I would agree. And let's see if it passed the best of breed test. Let's go 5 years. Now Walmart would be the black. And guess what? Got us. See, that's why you have to do that check. Walmart over a 5-year period is not beating the QQQ, nor is it beating the S&P 500.
The S&P 500.
Yeah,
exactly.
But you would think Walmart is a best of breed. So that's why you have to do that check. Let's go over a 10-year period. And I'm blocking it here, but trust me, it's 10-year right there. And Walmart is underperforming.
It's underperforming the Dow Jones Industrial Average, all of the indexes. That
was a good question. I like that one. So again, that's why you have to go to the charts and look. And Patrick, hopefully we show these guys how to do this. We have done it in the past. You go to barchart.com, the free version, and then you do a compare. They have a thing down here called stock compare, and you click on Patrick. You in the way actually. Let me.
Actually, Troy, there's one more question.
You go real quick, Patrick. You go to stock.
One more question.
Patrick, real quick. Patrick, let me finish my thought. Let me finish my sentence here.
I'm sorry.
All right. So you go here down in the company section. You click on stock compare. And let me go here. You click on stock compare here. And then that's how you can compare various stocks to confirm if you actually have a best of breed company. And a best of breed company is a company that's beating the indexes, right? So, all right, Patrick, what was the question here?
Yeah, sorry to interrupt you there. The question was asked, how about Target?
Target. I would think
Yeah.
Target. I would think Target would be in the same bucket as the others. Let's go look at Target. All right, that's a good question. Maybe there. Let's blow this up. I'm gonna blow this up a bit. I'm gonna go straight to the 10-year. Right. I'm gonna go.
Yes.
Target.
Yes.
Target is TGT.
Yeah.
Click on it and let's take a look. Oh, Target is not beating the QQQ.
No, it's not.
It's not beating the QQQ. So I would say another good look. But that's the whole point here. And Target is definitely not beating the QQQ, right? So
Yeah, it's
Target would
barely-
not. Yeah, Target would not
Yes.
be it. But I'll go back to another suspect. I'll go to Costco and look what Costco is doing over a 20-year period. So, right? So Costco is killing the game. So, yeah, that's the way it's done, guys. Those are simple techniques. And that's just the best of breed techniques for our beginner investors so that you'll feel comfortable investing. And also, guys, you can look at a 10-year period, a 5-year period, a 2-year period. Even if we were to look at these companies like Costco over a 1-year period, you would see some losses, but long term, you're going to win. So, let's look at a 1-year period for like Costco. Costco is still doing 16% here in the black compared to negative on the indices. So, anyway, any other questions, guys, before we get out of here? And Patrick Dog in the background in California keeps driving us in. We have Marvin Take in the building. Guys, if you found this content helpful, enjoyable, share, like, and subscribe to the channel. Gail at Night, please hit me at betoutofdebt@gmail.com so we can figure out how to get you a wrench if you would be so kind enough to join us. And don't tell Richard Mack. If you tell Zoom to Thailand, your YouTube husband, I'm going to have to make it up to him with a super chat. And I think that's it, Patrick, unless there's some other questions in the chat. Casual Economist, thanks for joining in the building. I see you still commenting down there. Patrick, I think we're going to wrap it up, my friends. If you can, look at Nike. Hold on. The Casual Economist is in the building a lot. I got to take care of the regulars. Let's go look at Nike real quick for the Casual Economist. So I'm going to go over here. I think Nike's NKE.
It's NKE, yes.
I'm going to blow this up. I put Ike Turner, NKE, Nike. And then let's look at Nike over a 10-year period. Let's just go right to it. It's close. Casual Economist is close. It is close. 389 right on top of each other. But that's a 10-year period. But let's look at a 20-year period. And that's when you start to see the separation. Almost 2,000% return. So if you see these big drawdowns, don't get scared. Look at this big drawdown. This is what we call dollar cost averaging, buying on the way down and getting stocks cheaper so that you'll make more money later when it goes up. So you will even beat those averages if you dollar cost average. And we did a show on that about 6 months ago.
And you're buying more shares at a cheaper price.
You buy more shares at a cheaper price. So you even beating that average if you dollar cost average, meaning you don't want to buy all at once. the best way to invest in the market is to do monthly or weekly over time, not buy all at once. You get some stocks more expensive, you get some stocks cheaper, but as you buy them, when they're cheaper, you accumulate even more at a better price. All right, Patrick.
And the key to that game is do it consistently.
Yeah. All right. So let's see if we can get out of the building. Marvin Jenkins said, how is the stocks doing everywhere? The stock market is coming back, but it is, I believe, a bear market. Patrick believes that the market is turning around. I think it's a bear market bounce. Mr. Marvin Jenkins, I believe that the stock market is going to go back down, that this is what they call a bear market bounce, meaning the stock market is going down, it goes up significantly, and then goes down even further than where it was before. Mr. Patrick Doherty, you think otherwise. What do you think?
I think that the market is actually coming out of the bear market. I think the things that have plagued the market, such as supply chain issues, are being resolved. I think inflation, particularly if you look at the CRB index and some of the components that go into the CPI reports, have definitely come down. The latest CPI reports, the PPI reports, PPI being producer price index, CPI being the consumer price index, have come down in the latest read. That's why you've seen such a rip this week, and I think that will likely continue. I think the war in Ukraine, I think will have less of an effect on supply chain issues. So personally, I think it's going to be a grind upwards, but an upwards grind nonetheless.
And that's why you have to decide for yourself. And when people ask me, what's my opinion on the market, it's just my opinion. You do your homework and you come up with your own thesis. You see, we both differ. We both differ.
So, but whether we're in a bear market or bull market, make sure you still buy best of breed, like the exercise that we were doing throughout the show.
Right.
And then you will always win.
And Patrick, to be fair, we trade, right? So we do swing trading, and swing trading is when you're trying to time the market to make money. So, I mean, both of us make a few $1,000s a month swing trading just on the regular. And so, but if you're just long-term investing, which this show is about, and not getting into the complexity of swing trading in a bear market, downtrending market, then, you're all good. Long-term invest and you're good. If you want to risk more and make more, then you can start trading a little bit. And I don't like swing trading in a bear market, to be honest. I'm waiting for the market to become a bull market, meaning the S&P 500 is consistently staying above the 50-day moving average. And when you see the S&P 500 consistently staying above the 50-day moving average, and then eventually over the 200-day moving average, that's when I swing trade. This guy right here, he's swing trading right now. And I just don't have the stomach to swing trade in this type of market. But these are good markets to make money because there's a lot of volatility. So, but Patrick, yes. I don't want to go into great detail, boring our audience with all of this type of stuff.
No, I would agree.
Patrick, you want to address this question here before I talk about our friend from Colombia who got his smile and supposed to be on today and not here today? But go ahead, Patrick.
So Sake asked, should she target parent companies? And all I can say is, provided that they have strong fundamentals, sure, you could target any kind of company, be it a parent or not. But again, you got to do the same type of analyses that a company that might not be a parent company that still trades. In that respect.
Yeah. So best of breed is best of breed. Just pick the best of breed company and validate with the charts. Very simple. Any athlete can do it. Any beginner can do it. It starts from there. And then as you start making money, trust me, you're going to start learning more. You'll start going into, 50-day moving average, 200-day moving average, forward PE, growth rate, PEG ratios. Then from there, you want to go to the next level. We'll start talking balance sheet, income statements, and cash flow statements. I mean, yeah, but really you don't have to do all of that to make money in this market. I just showed you there, you know? So, all right, Patrick. So looky here, man. We supposed to had a guest on today, and he went down to Columbia. Now, I'm out in Virginia right now. I have the set here in Virginia as well. So I've been out here on the East Coast for 3 weeks now. So I'm here in Virginia. I was going to have this interview with this guest who went over to Columbia. He got his grill done. He was quoted in Seattle, where I live, and we'll be going back next week. He got quoted $36K to get his top and bottoms done. And he went to Columbia and got them done for $7. And he was scheduled to come on today, and it was difficult getting in touch with him for the morning. So hopefully we'll have him on soon. And then I'm going to have a few other guys on. You know, I'm a travel guy. I travel for my profession. I am a degreed aerospace engineer, so I go around the world for the company I work for. It's not that difficult to figure out an aerospace engineer in Seattle, which company I do work for. And plus people at work, they actually follow me. So I have a number of people from work that kind of understand my background in this financial game and follow the show. But I guess the point is I'm going to have more travel bros on the show coming up and sharing their experiences. This passive investing and the way we can make money from our money is a great way to explore the world. And once you retire, you'll be able to, make a living without working for someone. So that's another good thing about this. Patrick, once you learn how to fish and make money from your money, there's no other, my friend.
Exactly.
I think...
Just one more question. Are holding companies a good investment?
Absolutely. For best of breed companies, yes.
Yeah, there's a company called KKR, which is very solid, and that's a holding company.
We just show proof of that. But you have to stay on top of the fundamentals. What is fundamentals, Patrick? The news, the new CEO,
and the financial statements,
competitors coming about, and so what you invested in became obsolete, like the Kodak camera. So there is some risk, but you have to stay in tune with why something is best of breed. And then once you feel like they do not have that lead, or there's a lot of competition out there, a la Netflix, then you could decide what you want to do with your money or what have you. Okay? All right, Patrick. We stayed on here a little longer. Yeah, Berkshire Hathaway. Yeah.
Berkshire Hathaway.
Berkshire Hathaway, yeah. And A or B, yeah. Most people can only afford the B, Patrick, not the A.
Right. So I would say that's a good company. Because I've been tracking it, and it invests in a similar companies as the S&P 500 index.
All right, guys. I'm glad that we had some participation here, and I hope that you enjoyed the show today. I hope we kept it very basic and simple. That's the purpose here. We're going to start going into some more advanced techniques like we did in past shows. You can go to betoutofdebt.com, guys. You go to betoutofdebt.com, you can see all our past shows. And we have shorts, like 3-minute clips on how to open a brokerage account and different strategies. So check that out if you get an opportunity. All right. Another question here. This is from Marvin Jenkins, Patrick. So the stocks will go back up. Absolutely.
Yeah, absolutely. Over time, that always happens.
That's 100%. The stocks will always go up. How much time it would take, that's the question.
And how much volatility you'll have to endure in the meantime.
Yeah, for sure. All right, Patrick. So hopefully we can get our guy from Columbia on in a week or so. I can connect with him.
Yes.
Any parting words, Patrick? Or anything else in the chat? If I do not see anything in the chat, I'm going to wrap this thing up. Any parting words for you, Patrick?
Yes. So, I mean, we introduced this topic, in an investing and money management by showing how some of these athletes, some of these famous people have gotten into financial trouble. And the key of the game is, first of all, you got to take care of your money first. So take a little bit off the top first. And also, if you don't think you know how to invest your money, try to educate yourself on the basics of investing, or choose a true trusted financial advisor who's got a good track record. That's all I can say.
All right. Words to live by.